Welcome guys, my name is Ahmed Khan, the numbers guy from Phoenix Financial Training. Just going to give you a quick summary on the accounting standard IFRS 16. Remember, this is not me teaching you the accounting standard, just giving you a quick summary on what IFRS 16 is. First of all, we need to establish if in a lease contract, are you getting the control on the asset or not? So if the lessee is getting control on the asset, then the contract will qualify to be a lease. If you're not getting control on the asset, then this will not be a lease. An example is sometimes lessor can have substantive substitution rights. This means they can change the asset given to you at any point of time. If this is the case, then this is not going to be a lease contract as the lessee does not have control. So the key word here is control. In a lease contract, lessee has to have control on the asset. So if the contract qualifies to be a lease, then the lease accounting rules will apply. If it does not qualify to be a lease, guys, then in that case, it will be recorded as a service level agreement. Any lease payments made will be debit expense, credit cash. And as I mentioned, if it is qualifying as a lease, we will use the lease accounting rules. What are these lease accounting rules, guys? Lease accounting rules are lessee will record an ROU and a lease liability. Obviously, you have to see from the lessee's perspective and the lessor's perspective. Lessee will record initially an ROU and a corresponding lease liability. What will the amount of the lease liability compute? It's going to be the present value of future lease payments. Whatever future payments lessee is making, all those payments discounted at the present value. And it can include any other payments as well, such as any guarantees towards the future, any payments to be made to acquire the asset if they are probable to be made in the future. Having said that, the asset will have to include the purchase price, which basically is any lease liabilities being paid in the future or any lease payments made in advance. The IS 16 rules apply. However, in the ROU, we don't have an instant purchase price. We will be paying in the form of future lease liability. So the part of the ROU will be present value of the future lease liability, any directly attributable cost, any advance lease payments, and any dismantling future costs as well. This is all the initial recognition. Initially, moving forward, the assets will get depreciated on the shorter of useful life and lease term. Net amount of the ROU will be presented in the statement of financial position. Lease liabilities, whereas on the other side, are held at amortized cost. Amortized cost meaning the opening lease liability will increase with the effective interest rate and it will reduce with the lease payment. Closing liability will be split between current and non-current. Moving on to the concept of separate components. Sometimes one contract can contain both lease and non-lease components. Entities can choose to record each one of these separately. If they choose to do so, they will have to break down the lease payment into the lease components and the non-lease components. Lease components obviously will be treated as per the lease agreement, the IFRS 16 accounting. Non-lease components will become the expense in the financial statements and they will be reduced from cash just like a normal service level agreement. Lessee does have a simplified option to record the lease in their financial statements if the lease contract is either short life or low value. In this case, entity does not have to record an ROU and a lease liability. Instead, they can just record the lease payments on a straight line basis with debit expense and credit cash. Moving on to lessor accounting now. Remember that the lessor still has to differentiate a lease as operating lease and finance lease. Finance lease is where the lessor transfers the control of the asset to the lessee, whereas an operating lease is where the lessor retains the control of the asset and does not transfer control to the lessee. I always say finance lease is a major lease, operating lease is a minor lease. This is how you can remember them. In a finance lease, of course, because the lessor is transferring the control to the lessee, they will have to de-recognize the asset from their financial statements. If you watch my video on recognition and de-recognition, you will understand a little more that why when you lose control, you have to de-recognize an asset from your financial statements. Even though lessor might be the legal owner, in economic reality, this asset will be removed from the lessor's financial statement, and instead, a receivable will be recorded in the lessor's financial statements. Now, why receivable? Receivable is the present value of the future money which the lessor will be receiving from the lessee in the form of lease payments. This is just initially. Moving on, at the year end, lessor will hold this receivable again at amortized cost. The name is amortized cost. Essentially, it's not a cost for the lessor this time. The receivable will be increased with the effective interest rate, which will be charged as a finance income. Now be very careful. For a lessee, when we increase the liability with effective interest rate, that is a finance cost in the P&L. For the lessor, when we increase the receivable with the effective interest rate, that is a finance income in the P&L. We reduce the total receivable with the payments which we are receiving. Like a receivable, you receive the payment, the value of the receivable goes down. Closing asset will be split in the current and non-current asset. This is done with the help of an amortized cost table as well. Talking about operating leases, where the control is not transferred by the lessor will retain the asset in their financial statements, and lessor will be depreciating the asset in their financial statements as well. Then any income which they receive from leasing out this asset will be simply recorded as debit cash, credit rental income. It's a simple rental income in the lessor's financial statements. Once again, this is a summary video, not teaching you the concepts, just revising them with you. Talking about sale and lease back. This is where the owner of an asset can sell the asset to another entity. The legal ownership will be transferred to another entity, and they will immediately lease the asset back. Now the original seller, be very careful, original seller will still be using this asset. This is why we need to establish if this is an actual sale or not. This is done by understanding if the original seller has transferred control of ownership or not. If they have transferred the control, then this is an actual sale. If they have not transferred the control, then this will not be an actual sale. One of the examples can be if they are taking the asset back for majority of its useful life in the lease, then this means control has not been transferred. However, if they sell the asset and lease it back for a short period of time compared to its useful life, then we can say the control has been transferred to the new owner. So once again, if control is transferred, it's an actual sale. If control is not transferred, it is not an actual sale. If it is an actual sale, then what do we do, guys? We de-recognize the asset from the financial statements of the lessor, and we record an ROU and a lease liability. ROU will be the portion of the previous carrying value to reflect the rights retained. If it's not an actual sale, then we record the cash received simply as a loan in the financial statements of the original seller, and the asset will not be de-recognized. Hope that made sense.